Welcome back to J-WIC FX online tutorial. It's been quite a long time. You missed me. So let's go to today's what we have for today. First of all, we've done directional bias in other video. Right, so we also learned the market structure on here, where we talked about bullish structure, bearish structure, and a ranging structure, which I did give a strategy, a scalping strategy called the boss model strategy, which we easily get on BTC. All right, now today we are going to dealing with zones. And you can see here indicated higher time frame, that 4 hour or 1 hour time frame. You can actually get zone in multiple time from different time frames, but you know, higher time frame tends to have more intense effects, precise effects more. So that's why we get our zones first on the higher time frame. Let's go to the chart. Let's begin to explain what zones are. So what are zones? Zones in the market are just some specific area where the market have a lot of pressure, either a lot of buying pressure or a lot of selling pressure. There are areas where the market have high probability of reacting, either it's going to buy or either it's going to sell. And how do we spot this on the market? It's very easy. How do I spot zones on the market? First of all, the easiest way is just look for where there's a lot of accumulation in the market. Remember, you're going to be doing this from a higher time frame, right? Look for where there's a lot of accumulation in the market. Boom, things like that. Okay, so there's an accumulation. I believe not accumulation, is accumulation, which sits here, which is the whole of this. So this is a zone. I'm going to show you 3 types of zone here. We have the demand zone, we have the supply zone, and we also have what we call flip zone. The 2 major ones I use is just the demand zone and the supply zone. So what is the demand zone? The demand zone, this a specific area where it's from accumulation and there's a lot of buying pressure here. So the market comes into this zone, reacting a certain time of way and begins to buy. That's what we call the demand zone. In the case, okay, so this is a demand zone. Now the same goes for a supply zone. There's a lot of selling pressure there. How do we spot this? Spot it where there's market accumulations. Okay. So here is our accumulation, and we have the supply zone here. As I say, the what we call it, demand zone, a specific area where the market has a lot of buying pressure, and supply zone, a specific area where the market have a lot of selling pressure. So how does a flip zone look like? Now, where we had a supply zone before, okay, we're expecting the market to sell here, but what happened? The market broke it. Let me use this. Let me use this instead. So where we had a supply zone, okay, we're expecting the market to react in this zone here. Let's say there was an accumulation here, so we're expecting the market to react there and take down. But what happened? It broke above the supply zone, and that supply zone will now turn to become a demand. That is where we see flip zones. And I can tell you for sure, what I used to trade gold are mostly flip zones. Mostly flip zones. As I've checked gold for some time, some good times. Before gold will come to, let's say, a demand zone that's usually on the last low, it takes a lot of time, and I've backtested is that gold usually reacts more on flip zones than demand zones and supply zones. Okay, so a supply zone that was bridged and now turned to become a demand zone is called the flip zone. So this is a flip. Vice versa, a demand zone that becomes bridged and turns to what do you call it, supply zone, is also a flip zone. That's that for that. Now let's come to the market and spot some zones. So I'm on my 1 hour, and we're going to be spotting zones. So get the first gist. How do we identify zones? There are lots of zones in the market. Okay, a lot. Zones are places where the market tends to react. And what types of zones do I pick? I don't just pick anyhow, any type of zone. I pick zones that are usually at, let's say if it's the demand zone, I pick demand zones that are usually at a very very good point of buy areas. Okay, in case of selling zones, I picked ones that are very good at selling areas. What is the word now? Discount prices. Let me use the Fibonacci to explain, to draw something like that. Discount prices and premium prices. So from the 50 points of Fibonacci, anything above here is seen as a premium position. And what I'm saying is because we are selling, okay, premium for sale, discount for buy. Then anything from 50 downwards to this 38 and blah, blah 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 won't be a very good point to sell. So from 50 above, we can say that that's a very good premium point to sell. So looking from here, we can see that there's an accumulation here, a very big one, huge accumulation from the market before it dished out. If I can draw this out for you to see, you can see the whole of what this market did before it. Okay, so all of this is an accumulation, and you can see what the market did here. This is very huge. You might not like to get into a market like this, because where do you want to set your stop loss? That's why some other factors are considered. Now you can see this is supply zone. Market tapped into it, dished down. So I made this break of structure. Where do I find my next supply zone? Go again, go again. So I needed to flip that. I'm still doing the same thing, sorry. Let's go again. Okay, now discount price from 50 and above, divide position since you want to sell. Okay, the whole of this, I said sorry, premium price, the whole of this from 50 feet upward will be a very good price to sell from 50 upward. Now let's spot out the supply zones that will be there. You can see this beautiful accumulation. You can see this one over here. But see a lot. I don't even need to draw this because there's a lot there. Look at how much it is. The whole of this is the supply zone. You can keep this in future reference. The market will react to it. Okay, you can just keep it in future purpose. The market do tend to come and react to things like this. Now the market break structure to the downside again. The break of structure to the downside. Oh, that has entered there 15 minutes. On that break of structure to the downside. Okay, where will you likely want to spot what do we call it now? Supply zone. Here, there's a lot of accumulation in this place again. So we're just spotting the bigger part. Okay, you can see that the market reacted to this before it took it out. You can see this sell. Those that scalp can use this. You can see this sell coming down again. This was the next break of structure to the downside. Where can we spot? Look at this place. Look here, there's a lot of accumulation here. The market reacted to it more, first took it out. Now from here you can see I already picked out another block because there's a zone here, a supply zone here. The market reacted to it very well, waiting for markets to give me some indications why I should sell, and do that. Now come to this. Okay, you can see this accumulation here. Just take your time, go to your higher time frame and spot out places where the market made accumulation. Where will you likely want to spot those things? Either in a discount, either Fibonacci retracement, a discount levels or premium levels. How do you spot good ones? First of all, how do you spot the zones from looking at accumulations? How do you spot good ones? You can use your Fib retracements. Just use 50% above or up, depending on how you position Fib retracement, will be for supply, which is what premium prices, while below that will be for what demand price, which is what discount price. So let's come to this now. I spotted out this accumulation here, mark it out, which you know this will be a what demand zone. You can see this. I kept this here because I know the whole of this is on that demand zone. Okay, the market didn't come to react to that, but that's on that good demand zone. So now, why I say depending on how you place your Fib retracements. Now the markets, since we spotted out this what's the demand zone where market but I need to turn this Fibonacci around because it's a retracement too. Okay, where did the market retrace to? Come on, good. So now from this 50 downward, a very good demand zone would be on the discount prices. You can see the market is still under the 50% Fibonacci retracement and reacted. There's a zone here if you go to a lower time frame and reacted to this boom to the upside, but very strong ones will be from 68% to around 78%. That's why I spot out this zone here. and refined it to my lower time frame. You can see I refined this to my lower time frame. Same thing here. The accumulations here picked out. Market will tend to react to that. That's a demand zone. Come here. The same thing. The market will tend to react. You can see this. Should I zoom in? You can see this accumulation. Nothing's happened till it distributes. Okay, till it distributes. That's on that good demand zone. Same thing here. Now look at a very good flip zone. When the market broke structure to the upside here, I was expecting this to be a demand zone. Okay, I was expecting this to be a demand zone, but look at what happened. The market went straight, bridged it, and now this zone, if the market reacts to this place, which will now, like the demand zone turn to a supply zone, that's what we call a flip zone. Right, look at this as well. Market can react to this place again because there was an accumulation of demand zone here, but it was breached, so it now turns to a supply zone, and if market reacts to it, that's what we call a flip zone. So other things you would like to know on spotting a very good zone, because we want to keep our things simple. We don't want to just go into the markets and looking for accumulations almost everywhere, so you not get confused. Okay, what are the things I do spot out when you have this accumulation? In getting a very good zone, either a supply zone or a demand zone, ensure that there's market gap. Okay, is the market gap now? Just ensure that there's a distribution, a lot of momentum after the accumulation, not a market gap. Just ensure that there's enough distribution after that accumulation. Okay, enough distribution after the accumulation. And what would you like to see there? There should be fair value gaps. Fair value gaps. That's on that topic. Let me just give you a little illustration of how real fair value gap is. One, using 3 candles. Usually 3 candles you can detect. Okay. So a fair value gap usually between 3 candles. I'm assuming bullish candles in this case now. Usually between 3 candles. When the market makes a momentum like this, there's usually a candle at the middle where should we just use price, where there's, should I call it vacancy? Where there's vacancy. Alright, there's usually a gap at the middle where there's vacancy. Fair value gap is on that topic on its own because there are some rules to fair value gap. Okay, sometimes if the market should have a wick from here, invalidating this structure, invalidating this space in this middle candle, it becomes an invalid fair value gap, FVG. Okay, it becomes invalid in the sense that that candle has already tapped into the space of that gap. So fair value gap is just like should I say, where there's enough momentum and markets have left have not reacted to that space. Let me put it that way. Okay, so in the market you can see after this zone here, after this zone, or come to place after this zone, you can see this long candle. Okay, there's a bearish candle here, a long candle. Fair value gap is on that topic. Maybe we'll talk about that in the next video. A bearish candle, then a very long bullish candle on that bearish candle. The whole of this space here is a fair value gap, and you can see that the market has come to tap into this place and dish out to its main direction. Okay, that's even strategy people trying to use. So when you get good, when you spot out good zones, not that the market just accumulated alone, there will be enough distribution and you should be able to spot good fair value gaps there. Look at this again. Look at this demand zone we spotted out here. You can see that it's accumulated here, creating enough momentum, causing gaps. Okay, causing gaps, and this was where the new bearish candle came in. And look at this, the market has tapped into this fair value gap and it dished out. If you spot other ones, the same thing. There's a zone here, beautiful. There's a full zone here where the market accumulated. All right, a demand zone. Now see this fair value gap, this space in between here. The market has come, dished into it, and boom. So that will be all for this video. Hope you enjoyed it on how to pick zones. Let me just summarize it a little. Get accumulations. Okay, there are 3 types of zone we taught here: the supply zone, the demand zone, and the flip zones. How do we spot this? Look for where there are enough accumulations in the market. Enough accumulations, then market tends to react to those prices. Market tends to react to those places. After that, to pick best zones, you can use the fib retracement tool. Look at where the discount prices are. Look at where the premium prices are. You know, we use 0 to 50% and 50 to 100. Just use that to divide and the way you place your Fibonacci retracement depends when you're on a downtrend or when you're on an uptrend. Okay, then a good accumulation, a good zone will be that have enough distribution and a fair value gap attached to it. That zone will tend to react very well. That's all. Thank you.